Welcome to the Live Squawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary. Hello and welcome to Live Squawk's Market Talk Weekly. This is where we try and break down the key stories of the week gone and the implications for the markets. We'll also take a look at the week ahead and try and give you a heads up as to what you should be looking out for. I say we because every week I'll be joined by a market expert in their field. And this week I'm joined by Mike Zaccardi, a financial writer focusing on markets, investments, retirement planning, and personal finance. Hi, Mike. How you doing?
Good, Harry. How are you?
Not bad, thank you. Not bad. Well, I'll bring you in shortly to go through some of the topics. But first, before we get into it, a quick bit of housekeeping. The content provided on this channel is for informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We're not responsible for any losses or gains that may result from following the content on this channel. Okay, let's get on with the program and take a quick look at the week just gone. So, Mike, how's your week been? I guess it's been a busy one for you with all the central bank decisions.
Yeah, very busy on the macro. A lot of exciting stuff in markets, but price action is actually fairly quiet. So pretty quiet response to all the news this week.
Well, we'll get into it in a minute, but do you think that's simply because a lot of this was telegraphed and has been well priced in over the course of the last, I guess, 3 to 4 weeks?
Yeah, absolutely. It really all started with Powell's message at Jackson Hole, basically, effectively teeing up a Fed rate cut, which, leading into that wasn't all that surprising after the July payrolls data that was seen a couple weeks before. And then, the Fed had an opportunity to kind of walk that back ahead of the blackout period before this week's meeting. They didn't. And so we got our 25 basis point cut. The FOMC statement itself was fairly dovish. Of course, we had Stephen Myron, freshly on the voting committee, and we all saw what his dot was for year-end policy rate target. But in Powell's press conference, he took kind of a more measured stance. It was a little bit of a muddled overall response to media questions. And I think that kind of kept a lid on equity market gains in the afternoon on Wednesday and all the way through today. Thursday was definitely a nice broad-based rally, but we don't see that same kind of exuberance that we saw on the Friday of the Jackson Hole Symposium.
Yeah, that's a good point. I mean, I covered the event on the Wednesday itself, and what you did see was, again, maybe it was down to the questioning and the way he answered it, but you definitely saw markets in two-way flows, really. How deep the volume was, I suspect it wasn't particularly, but what you did see was markets initially thinking, oh my God, he's been a bit more dovish, and then flipping that and maybe more equities. It was a bit two-way movement. The bond yields kind of made up their mind, but we did see a fair amount of flipping, I think, between the course of his press conference. For those who may have missed it then, where were you? But the FOMC voted 11-1 at their meeting to cut the Fed funds target range by 25 basis points to 4.25%. We had an SEP, so we had new dot plots and new economic projections as well. And the dot plot showed an approximate split between policymakers who looked for an additional 25 basis point cuts in October and December, and those who preferred a more gradual approach. Just a note here from HSBC, it says, in terms of our own projections for the Fed funds rate, we maintain our long-held view of only 2 more 25 basis point cuts in December and next March through end of 2026. As noted, they said there is some risk of a bit more easing than is in our forecast, given labour market developments. On the labour market developments, do you think there was any real possibility that more people would have joined Mirren in voting for 50, or do you think they purposely sort of stuck as one, just to send a message, I think, to the administration about Fed independence?
Yeah, possibly. Of course, at the July meeting, we had Waller and Bowman dissent for a quarter point, and then I would say they joined the rest of the committee this time around. They got their point across in July. They got their quarter point cut. Everyone kind of knew Myron would be out there with his vote. So yeah, I would agree with that. I think it's always been a priority for Chair Powell to kind of herd the cats when it comes to the FOMC decisions and bring everyone together. He knew he was, we can presume he knew he was not going to get that with Myron. So yeah, I think that's a fair assessment. The FOMC definitely wants to keep a cohesive message together, at least when it comes to the voting at this point. But it's going to make the next several meetings very interesting with Myron as a temporary filler on the committee. It definitely kind of reduced the drama. There was a potential to see dissents both ways. There could have been three or more. If we had Waller and Bowman kind of lean more with Myron, and then if we had like New Salem and some of the other hawks on the committee, opt for no change. So, and then there's a whole Lisa Cook drama too. So, I think we got through it all pretty unscathed in terms of unnecessary drama, and the markets have a way of sniffing all of this out and sussing it out. So, it could have been a lot more. There could have been more fireworks, but there weren't. So I guess everyone's happy about that.
And do you go with the general sense that we are on limited rate cut path at the moment, or do you think? Again, I had a discussion earlier in the week with another podcast, and some suggest that we could see further dampening of economic growth in the months to come, and definitely from the labour market, which could potentially see it into negative territory. Do you go along that side kind of view?
I don't know. I've been thinking about that this week because we've obviously had the very weak payrolls data, and of course the revisions. The revisions make it now so that there's 3 of the last 13 months for the U.S. employment numbers have been negative, which obviously isn't good. But we saw initial claims still are low. We had the previous week we had a spike due to fraudulent claims in Texas that reversed in this past week's claims reports. So now that's back near 230, which is fine. And continuing claims, they had been printing the highest level since November of 2021, and those are actually now the lowest since May. So that's not a total all clear, because it's possible that folks are just simply rolling off of being eligible for unemployment benefits, or they're just giving up looking altogether or something. But there's certainly indicators that suggest beyond the NFP reports that the labor market is still doing all right. There's been a lot of talk about the challenger job cuts. And while they're high on a year-over-year basis, if you zoom out and view the entire picture, those are still fairly low as well, compared to what we saw earlier this year. And there's always there's a lot of Doge effects in that from earlier this year too that have are no longer an issue. So I don't know. The labor market's tough. Obviously, the break-even pace of monthly employment growth is very low now, probably 30 or 50,000. So it really would take some very soft labor market prints to take the unemployment rate higher, given the drop off in immigration and the deportation efforts and that sort of thing. So
it's been quite noisy on that front, hasn't it, in terms of taking all that into consideration?
Yeah, you really have to look through a lot of things with it and look at things holistically. And then you get things like retail sales, which still look very good. And that's going to support growth. We're looking at this quarter, potentially seeing U.S. real GDP growth between 2% and 3%, which is certainly above what people were expecting just a month or two ago. So, I mean, my take on this is, the market's pricing in about, a cut in October and December. I wouldn't be surprised as time goes on, as long as we don't see dreadful data, to see some of that easing get wiped off the board a little bit.
Okay.
I don't think it's necessarily a one and done, but given the retail sales numbers, given kind of a troughing, I guess, in the overall claims picture, it's just one of those things where folks are looking for the next shoe to drop in the economy. And I feel like we've been playing this game for the last couple of years and it just hasn't happened.
No.
I wouldn't be surprised if we're kind of at that point again, to where we just might see economic data hold in there a little better than everyone thinks. I'm not saying gangbuster growth, but
around 2% growth rate would be moderate, I guess, and although slightly disappointing, but not disaster, which is what I think some of the analysts were looking for after retail sales. For those who may have missed the retail sales data for August, sales absolutely surprised the markets. They came up 0.6 for the headline rate versus 0.2% expected. The control group was up 0.7, as were some of the other metrics were up 0.7%. And we saw online and clothing sales were the driver of the gains. Autos was slow after a strong run, though, so a bit of payback there. And we even saw restaurant receipts up 0.7%. Which some analysts have pointed to non-essential spending. So, as you say, I mean, it's very hard to divine where the US household is at, really. As you said, we've seen the labour market, but maybe there's a more nuanced picture than we're seeing at the moment.
Yeah, and I think a lot of it comes down to the bifurcation, in the household spending environment right now. There was that Wall Street Journal article this week talking about how, the wealthiest cohort is really driving the bulk of the spending, which they always do, but it's certainly amplified at the moment. And it could very well be you have a lot of wealthier baby boomers now who are not in the workforce, so it doesn't matter what labor market is doing for them, and they're going to keep spending. So that's something to consider. And it could ultimately become a political talking point. It certainly will, I think, as we approach the midterms, as to, the kind of the have and the have-not economy right now.
Well, do you think then it turns to sentiment over and above what's in people's pockets? If people think things are on a downturn, then they tend to sort of just shore up their spending in that way. And again, we'll come on to the PMIs due out next week, but maybe the sense of well-being might change as we start to get more figures towards the end of the year. Maybe people see the inflation picture as eating into their spending power as well, because that's remained sticky. It's not, we've got this core PC out next week. Shouldn't be any kind of a surprise, really. Before we quickly get onto that, I just want to go through some of the other pieces of data. We had UK inflation data out this week. Added nothing to near-term interest rate narrative. We did see the Bank of England on Thursday, a day after the FOMC, leave rates on hold at 4%. Wasn't really much to come from that. We saw Bank of Canada, they did cut rates on Wednesday. It seems like a long week. They cut rates on Wednesday in line with expectations. And I guess the more interesting one was the Bank of Japan rate. Well, I say interesting. Bank of Japan rate decision. They kept rates on hold, but there is an inkling that we could see potentially a move come next month. Although, again, that will probably be dependent on the Tankan report and what we get out of that, and also the political picture as well, which is going to be interesting on that front. So, again, we had a number of the G7 central banks this week. If we take a look towards next week now, just see what we have coming up. As I mentioned, the US core PC price index there is kind of well flagged, isn't it, Mike? Because we get the CPI and we get the PPI readings out that precede it 2 weeks ahead. Everyone has a fairly good idea of what to expect from core PCE, don't they?
Yeah, and it's actually pretty encouraging there. We had the kind of ice cold PPI report for August, and then CPI for August came in fairly close to estimates, even a little hot on the core. But actually, the numbers that map over to PCE were really quite tame. And so we saw the sell side drop their August PCE inflation forecast. So, I mean, we're looking for up like 0.2, I think, on both, at least on the core
on
PCE
the core
inflation rate.
total. I think they're still going towards some are looking towards 0.3, but definitely 0.2 for the core PCE. And then I think 2.9% annually. Is that what you have?
Yeah, that's what I'm showing there. And certainly, obviously, it's way above the Fed's target, but they've missed their target now for what, like almost 4 years. So, I mean, their 2% inflation target is more aspirational than anything. And obviously, the stock market can do just fine with 2.5%, 3%. Kind of normalized inflation.
Yeah.
So yeah, we'll get PCE next week. I will be curious about those S&P Global Flash PMIs for September. Those are the first kind of looks that we get for this month. That will then set the tone for what we expect on the ISM numbers that come out in early October. So we'll see how those go. So it'll be a pretty busy data deck as we wrap up the quarter and folks true up their positions.
Just in your opinion, then, obviously stock markets we've seen record highs again, and do you think it's still? It doesn't appear broad-based. It doesn't appear to be that we're seeing the corporate world. It's definitely not doing bad. We saw earnings for Q2 earnings, and they were decent. There were a fair amount of beats. We'll get Q3 out, and we'll have a look at those. But do you get any sense that a bubble mentality coming into it, or we could argue that point for many years, but from your perspective, you follow these markets day in, day out, what's your view on the equity market?
We had a very good Q2 earnings season. EPS growth came in 11-12% versus expectations of about 5%, and I think the bar is going to be low enough for Q3 that we should hurdle that fairly easily. But since the April bottom, the Mag 7 have posted returns almost double the S&P, but we're seeing outperformance too from small caps. The Russell 2000 is actually beating the S&P.
That's a good point.
That April 9th low, and we're still seeing nice price action out of international markets. You back out the dollar, and U.S. stocks and ex-U.S. stocks are about the same. So that's a good thing. Like, we're seeing global breadth too, not just in size. I like the broadening of the rally here. We had the first day in 4 years where we had the Dow, NASDAQ, Russell, and the S&P hit record highs. And, no one tossed in there too. We had the foreign index, the all country world ex-US, the AQUIX, also notched a new record. So, frankly, we don't see this very often. So, and all of this comes during a very bearish part of the year. The September Scaries were much talked about, but the S&P's possibly going to put in its best September since 2010. So whenever seasonality kind of bucks the trend, that's something to pay attention to. And fundamentally, earnings growth, I think, is going to keep hanging in there, and we're seeing consensus S&P 500 EPS numbers creep higher. Well above $300 for calendar year 2026, which would be about 14% growth year over year. Wow. So, everything is tracking. It's just one of those things. Is the market cheap? No. It's like we have the S&P near 23 times earnings. That's certainly no bargain. But it's one of those things again where you can try and say this is the day we're going to start. We're going to have a correction, but that's a dangerous game to play.
It is. Just looking at some of the sort of figures here, consumer stocks are continuing to rally. Again, this is in spite of what some call economic concerns, and it goes back to that retail sales figure. Like, the US household at the moment doesn't feel that bad off, it would appear, from what we're seeing. So I think the sentiment readings are going to be quite interesting to see how they've been playing out. Really, we get back to the data focus next week, really, and like you say, some of these PMI surveys are going to be interesting. The University of Michigan, the ISM, and again, it leads us back to the sentiment now, and that's really, I think, going to guide markets at the moment. Listen, Mike, thank you very much for taking part in today's episode. Very insightful. Where can we find you if people want to see your work and where to contact you and stuff?
Yeah, just follow me on X, Mike Zaccardi, and I write for a number of places. Stockcharts.com is where I produce 2 macro trading oriented reports every week on Monday and Wednesday. I post those on X as they come out. So that's the best way to take a look at what I'm thinking.
Excellent. Well, listen, thank you very much again. Have a great weekend. And we'd love to get you on again for some insight.
Yeah, sounds good, Harry. Thank you.
Thank you very much. Thanks for tuning into the Live Squawk podcast. Your edge in the market starts here. Subscribe now.